Hey everybody, Jason here. Today we have the good fortune of getting to chat with our esteemed friend, Mr. Matt Zimberg. Now, Matt is the owner and CEO of Optimus Futures, and today we're going to be talking all things futures, from what they are, how they work, how to trade them, and most importantly, what makes Optimus the best solution if you're interested in getting into futures trading yourself. Without further ado, let's jump into the interview. So, Matt, thank you so much for being here with us today. Really excited to talk to you about futures. I kind of want to start with just the bare bones basics. What are futures and how are they different from stocks or options?
So first of all, thank you for having me. It's awesome to be here. Always glad to educate people out there. Because I'm a licensed broker, I always have to start with a disclaimer that there's a substantial risk of loss in futures trading, and past performance is not indicative of future results. And my personal advice always to futures traders, always use your risk capital. Don't use anything beyond that. So basically, just to start off, to give you a really broad definition, futures markets are macroeconomic markets. We're trading actually macroeconomics. So, for example, we trade broad indices, S&P, the entire NASDAQ, Dow, those things of that nature. And every single contract is a standardized contract, meaning that it has a specific point value, it has a specific size. And what I also mean by macroeconomic, we're trading different sectors. We can trade stock indices. We can trade, for example, the energy market, the crude oil directly. Not a company that produces crude oil, but the crude oil directly. Not a company that produces gold or manufactures gold, but the gold directly. So you actually trade the raw material, and it goes down to even the grain markets. And again, every single market has to, the beauty of those markets, and I think their advantage, they go through an exchange and they're standardized. So that's why I think people like them, and they're heavily regulated, right? So the futures, like for example, the stocks are regulated by the SEC. The futures market brokers are regulated by self-regulatory organizations such as the NFA, and we're all registered also with the CFTC. Also overlooks brokers and exchanges operations. So that's just kind of a broad definition. Now, your second question was related, I believe, to stocks and stock options and how they're different from futures, right?
Right.
So futures market are leveraged markets. Now, options are leveraged in themselves as well, but in the stock market, majority of the time, majority of the people are prone to go long when they think a stock is going up. In order to short, you need extra margin. And in the futures market, you don't. You put the margin for going long or going short is the same. So there's a little margin that comes out of your account, and then it goes back into your account when you close the position. And the advantage that people have in futures is that I think as people evolve as traders, they start maybe with stocks and they're saying, you know what, I want to buy a stock that goes up and I believe in its value. And then they proceed, as they see the market volatility, they say, you know what, maybe I think that the stock could go down, so they'll end up buying a put, right? But with a put and which is an option, an equity option, you have to basically be very specific on the price, time, expiry, and they're like, okay, that's a little bit challenging. And then they go into the futures market. Now, I'm not saying that the futures market is not challenging. It's very challenging because of the leverage used, but usually traders evolve over time and they move into the futures market. Some do start right away in the futures market because they realize its flexibility, but I think big chunk is just moving along to basically to have the ability to trade long and short. And sometimes, the indices will, their specific stocks that they're looking at could be flat, but indices in themselves, because they have so many stocks, could be a little bit more volatile. So it could be sometimes enticing for them to trade in those markets.
Are indices, I'm going on a little off script here, but are indices
Sure.
built off of futures contracts? How is that work exactly?
So the index is built of a weighted average of the stocks that are in it. It's a weighted average, right? So today, for example, the S&P, you have 30 major companies that move in the index. So think of all the stocks Like, for example, a collection of a weighted average, and that's how the index is being built. So it's just the collected averages of all the stocks that are traded in it. And of course, every single company wants to be in it because, then it's considered, to be of high, good quality, revenue, and so forth, because the people, for example, behind the S&P want quality stocks in their index. And that's what people actually trade. They trade the broad market, not an individual asset, but the broad market.
Gotcha. So then how does the liquidity and market hours of futures trading compare to that of other financial instruments?
So this is, I have to say, this is my opinion. There are aftermarkets in the stock market, but they're not liquid. Because futures markets are used by hedgers worldwide, it's a 24-hour market for the most part. Now, I would say that the liquid markets, I will talk about indices, for example, okay? And again, you have other people trade crude and gold, and it's around the clock. Remember, those are global markets. During the day in the US, I believe that the liquidity is higher than the nighttime, but
Sure.
nighttime can get just as liquid. So the futures market closes for 1 hour, right, between 5 and 6 o'clock. But after that, the market can get very volatile. And volatile means, that there's also many times liquidity in that market. Stocks, for the most part, in my opinion, they start at 9:30, finish at 4:30. Nighttime, very hard. The liquidity dries off. There are some news announcements, and it's really hard to get in and out. A futures market can be very liquid after hours. There are times that it's less, but I still think it's very liquid. During the time, by the way, during COVID, nighttime was just as heavily traded as daytime. It was just pure pandemonium across the board, for all the people. So the nighttime, it closed for an hour, and the same type of volatility resumed at 6 o'clock. And I'm talking in Eastern time, right? So, excuse me. And so people who trade futures can trade both during the day and during the night. And also, there's a number of futures markets worldwide that people can take advantage of. For example, majority of the people in the US trade through the Chicago Mercantile Exchange, but nighttime, some people will come in and trade, for example, contracts like the Eurex contract, right, which is the German economy, their index, or there's a contract in Osaka, Japan, called the Mini Nikkei, which is very liquid as well. So people who are looking for, I would say, action around the clock or volatility around the clock can literally look at a number of futures contracts worldwide to trade them.
Are all futures contracts available for that same period of time, that essentially 23 hours a day, whether you're trading like NQ or you're trading corn futures or natural gas or whatever?
I believe energy, metals, and indices are all around the same time. I don't remember I don't think contracts such as the grains have their liquidity is really during the day. I don't
Got
remember
it.
their specific hours, but those kind of contracts, the agriculturals, are pretty much during the day. But I would say that what people trade the most, which is the indices, the um, the debt instruments like bonds, treasuries, metals such as gold and silver, crude, unleaded, those are pretty much close to 24 hours around the clock.
Got it. Okay, so now we have a pretty decent grip on what futures are. We're kind of touching into why to trade them. But I guess I want to know what initially draws a trader to the futures markets. What kind of investors typically are out there trading futures?
Well, I don't have a profile of every single person in this business, but I will tell you the people that should be drawn to it are people who have high risk tolerance. This is not an easy market. Like I said, leverage, it's a leverage market. If there's a dollar behind every point value. So I believe that there are two types of people that run trade. Those are people who are trying to go long and short the markets, meaning that at any point in time, they have an opinion that the market is going up and going down, right? And for the most part, it's a technical market because it has to do with leverage. So this is those traders looking for the flexibility to go long and short the market. They're also looking to, again, like I said, to trade broader markets. But the people that should be drawn to it, if somebody's new to it and considering it, I would say that you should have above average risk tolerance to trade in this market. Again, because of the leverage, because of the volatility and everything else. So it's important to trade an asset class that matches your risk tolerance. Whatever you choose, you have to choose something that matches your tolerance. Some people can trade with leverage, some people cannot. And thank God there's enough financial instruments out there that I would basically say, would satisfy a lot of people out there.
Gotcha. Do you have an idea of kind of the most common misconceptions that new traders to futures come in with? And maybe we could try and fast track their misconceptions a little bit. Maybe you could give us how to overcome some of those.
I would say pricing, right? The pricing in the futures market. I believe in some equities, there's no commissions, no commission for equities, or there is, I think, very like a fixed fee for 1,000 shares or something like that. So one of the misconceptions I don't know is that they have to pay per future contract. That's how the exchange charges it. This is not a broker decision. This is how the exchange charges. The exchange charges per contract. We add our commission on top of the exchange. The that's just a pricing thing, right? So you have to know the pricing, and we try our best to explain that to the customer. The second thing is, the other misconception is maybe people, do not appreciate the effort that it takes to trade with leverage, right? Because your entire psychology gets intensifies with leverage, right? When you put $100, but you play with $1,000, the ups and downs could affect you. So you need to understand basically, how the volatility of the contract will affect you as a trader. I think majority of people today are, from what I've seen, they read a lot. There's a lot of information on the internet. But unfortunately, some get their information from the wrong sources. The wrong sources that, tell them that it's an easy one. There's a lot of social media out there, saying, look, you look how much I make and everything else, that's based on demo accounts, not real accounts. So I would say, just judge for yourself. If you're capable of doing it, don't try to be jealous of somebody out there. You don't know if it's giving you the right information or not. So I would say, a lot of misconception comes from wrong influences, right? They're encouraging over leveraging, all in. You have to be methodical in this business. You want to learn to be a trader. You want to learn all the aspects, and you have to take it slowly.
Got it. And I mean, that makes nothing but sense, right? Can you kind of discuss, I mean, we have kind of touched around this too, but can you kind of discuss a little bit more about the risks and the challenges that are unique to futures, and how they compare to that of a standard equities market, buying stocks or buying options?
Well, for the most part, I believe that when people trade stocks, they don't use leverage. So if a customer, for example, has, $2,500 and he wants to buy $2,500 worth of stocks, that's what he buys.
Right.
In the futures market, think of something like, the S&P, where every point on the bigger contract is $50. So if you, let's say, I'm rounding it off. So let's say, the S&P is trading at, let's say 5,000, and you multiply it by $50 a point, the value of the contract now is 25,000. And you can trade that, with a $500 margin. So now you're trading 25,000 with $500. This is what a lot of traders, this is what they seek sometimes. The volatility in the account could really affect your strategy, affect your psychology and everything else. Not to mention that you could also end up in a deficit if you're not careful. So in the futures market, you can lose more than you invest. Now, again, risk, people who are, understand this mechanic, try and do everything to work with risk management so it wouldn't happen. But sometimes it's, if they're over leveraged, it doesn't matter how much you try, markets can drop substantially, or if they're short, they could shoot up on good news or anything like that, like an interest rate news that will come in the middle of the day. So I would say that's one of the biggest factors in futures versus other instruments is the leverage that you use, and it can work for you and it can work against you. And you got to learn to work within that environment of leverage. That changes psychology tremendously. It's like your psychology, and then there's psychology and steroids, and that's
Right.
futures, right? So
Got it. So, with that in mind, then, are there particular contracts that you feel like would be the best place for a beginner to start, whether it be a particular asset class like NQ or TY or natural gas or what have you, and then maybe drill down even a little bit more into the different types of contracts that are available?
um, luckily, luckily, the CME came up with the micro contracts. And the micro contracts are 1/10 of the regular contract. So clearly, you have to start with a smaller size contract, and you have to feel if this is for you or not. Now, a lot of people, would basically use the micro contracts, and well, here's what I should say. They should use the micro contracts and build on it and see what kind of size they're capable of, right? And if they get to 10 contracts, then they'll say, okay, I'll trade the regular contract. But maybe their psychology will not allow them to trade more than 5 micros. So the micro contracts are the ones that they should definitely start with. Now you can trade less than one, so start with one, right? If you
Right.
have more experience coming from other areas and you have bigger risk capital, then you can choose whatever number of contracts you want. But essentially, I would say a beginner should say you should start with the micro contracts. Now, which ones? You have 4 choices in the indices. You have the micro S&P, micro Nasdaq, micro Dow, micro Russell. I think that the most popular one for traders, from what I remember, is actually the micro Nasdaq. I think it's big and it has a lot of liquidity. And then there's also micro crude oil, and there's micro gold. And I believe, I don't know if it's came out or not, but I believe that the CME is also coming out with micro natural gas. So definitely micro contracts, the smaller size that you can, practice on that, see how it's working, and then and then see if it works for you. Now, I just want to mention something else. I know it's in the context of what you're asking, because it's important to mention. A lot of people put, in my opinion, too much emphasis on paper trading. So they think that, paper trading, would lead them to better traders. And I say not necessarily, because, when you sit there and you paper trade, it's like flying an airplane from a computer versus flying it in the sky. It really like that, right? So people think that the longer time they spend on paper trading, the more they will be ready. The only way they will, I'm not saying not to paper trade, they should be familiar with the contract size, the hours. Demos are also very good to know the platform. So the trading functionalities, buy, sell, where is my position? You can trade on the chart, you can move targets around and things of that nature. But that's what it's good for. At some point, you have to move into the real world, and only in the real world you will know if this is for you or not. And this is where you can develop your strategies. Unfortunately, what I've seen happen over the years is that there's this push to do this demo trading, and then people trade a week, they're not so good at it, and then they go back to demo trading for 6 months, thinking that the strategy wasn't right. Even the best traders in the world, from what I've seen, if you look at their long-term track record, there's many months that they might not make money, weeks. They're not always consistent. So in my opinion, people should really look at longer term periods when they trade futures to calculate their returns, as opposed to judging themselves by a day or a transaction.
Yeah, I mean, Rome wasn't built in a day, right? This is the hardest business.
Correct.
It's the hardest business in the world, and there are countless stories of success taking many years.
One thing we have done in at Optimus Futures, we build a trading journal. And this trading journal allows you to see your P&L, the hours that you traded, the contracts that you traded. You can attach ranking to your trades. You can put notes. Um, you know, majority of people think that at the end of the day, if they'll think about the transactions they did, it would lead to better results or it would provide some sort of an insight. And I always say, you know, if you look at it in a journal, you'll be a lot more observant. It will give you better statistics than your own intuition. Like you might say, hey, you know, like micro NASDAQ MNQ, we call it the MNQ by symbol. So the MNQ did better than the MCL, than my crude oil. Maybe I shouldn't trade crude oil, right?
Yeah.
Every time I like this, or it could be vice versa. Or you can see when you take notes, you say, I was a little impatient here. I wasn't waiting for my setup to finish, because some people say, well, I might as well get in now because I think the setup will occur, right? So a trading journal would allow you to kind of dig into your trading soul, and make observations. So I recommend it. Listen, I'd be very privileged if every customer in the world was with us. But if you come to us, you know, ask for the journal. We give it anyway, of course, but ask for it and use it. Above all, use it. We build it. It costs us a lot of money, but we want customers to use it. And it's free, by the way. Every trading guy can get it, put the ranking, start doing it. And we listen to our traders all the time in terms of the features that they want on it. So
Yeah.
that's another piece of advice. You know, track your trades. Do not rely on intuition.
Yeah.
Not in entry, not in exit, and not afterthought, right after the market closes.
Yeah, go in with a plan always. So
For sure.
that kind of brings us into the idea of strategy, you know. Could you offer any advice on, you've kind of offered it already, but any additional advice on risk management? How should futures traders be thinking about risk? Um, any advice on it?
I would say that um, I would say that any trader out there should really think about the size that he trades. That's the first rule of risk management, size. Now, some people can debate me, right? Somebody says psychology is more important, strategy is more important, anything. But you know, your psychology get messed up when you trade a size that you can't handle. Your method gets messed up when you trade a size that you can't handle, right? So it's important to me in risk management, first of all, to trade the number of contracts that um, your what's the word I'm looking for, that your psychology is capable of
Like that
carrying.
you're comfortable with?
That you're it's beyond comfortable. You
Yeah.
know, it's really seeing how it's affecting you. You
Yeah.
know, and it's affecting your behavior and everything else. There's a point in trading that you think that you're making the decision. It's actually your chemicals making the decisions.
Mhm.
And this is what you want to avoid. You want to avoid when something else completely takes over, because you'll talk to traders many times who at bad days, they're like, we don't know what happened. And the reason is because, you know, listen, we're all built of chemicals, and sometimes this whole excitement makes us miscalculate and misjudge things. So I would say first rule of risk management is basically size. The second rule of risk management is knowing when to exit. When does the market tell you that the system or your method or whatever you call it does not work, right? That's the most important thing. Now, as far as so risk management, I believe that this is my opinion, but it's based on many years of talking to many people. I believe that people's method is not as important as their risk management. I'm not saying that the method is not important, but if you don't have the right risk management to admit when you're wrong and get out of those positions, what will happen is that your losing trades will be larger than your winning trades. So you got to have the ability to identify when am I wrong. You also have at the same time an equal obligation on the profit side to say, when do I exit? Like, when does the market tells me to exit? And if the trade is going way too good, I mean, it's going very well in my favor, how do I handle the strategy? If I have a number of contracts, do I peel them off slowly? Do I reach one target, right? And there's a debate in the industry. I've seen people go back and forth about whether to choose one target or to move the risk management up your stop losses, right? So
Mhm.
there's a debate going back and forth of which one to use, and I would leave it up to the traders. The only thing I would say on the stop losses is that, remember, stop losses are never guaranteed. They could, markets can gap, and there could be situations that they're not executed, right? And I'm also obligated to say it legally. So I would say that's the risk management side. Now, as far as developing a method, start with the simple. Start with simple. Start with moving averages. Start with RSI. Start with MACD. A more complex strategy. If you can't see the price from drawing, 100 lines on it, it means something is off, right? So, that's where TrendSpider is so good, because you can set rules, right? You should set rules and say, look, these are my rules. And when this happens, I'm going to do it. When I spoke about those traders who don't wait for their setup, it's a big problem. A lot of traders don't wait for the setup because they say, I might as well get in now because I'm going to have even a bigger profit. And it doesn't occur. The setup
Right.
doesn't occur. This is where TrendSpider, automating, saying, you know what? I don't trust myself. I trust a machine, right? A machine will tell me when this occurs, and when this occurs, I will go in, right? So this is where I love the idea of TrendSpider and rules. And with your founder, Dan, I have fascinating conversations about it. What I love about it is that, what I love about your company in general, of TrendSpider, is that you're really out there trying to instill discipline into people. That's the beauty of it, right? Instill discipline through software, through something. Even the best traders in the world, in my opinion, need a reminder sometimes. I'm going to tell you something funny, that every time I say it to one of my customers, they laugh. I say um, there are no intelligent mistakes. A mistake by an amateur and a mistake by an intelligent guy is a mistake. It's a mistake. It's the same thing. It's being over leveraged, overthinking, not applying it right. Again, sometimes even the best traders need the reminding of the basics. And I say, listen, you might be a trader for 20 years and you still need a reminder, right?
Right.
So that's basically it. So, I would recommend for people to use TrendSpider. Put your rules. Put your rules in. Start with simple things. Do not look in futures market. There's tons of methodologies, right? There's methodologies that are traditional technical analysis. There could be order flow. Some people look at market by order, the activity of the dome. There's a lot of orders, and sometimes beginners think that that's what makes the trader, the complexity of his method. No, it's the discipline of the risk management. So start simple, right? Grow from there. You can't go to, let's assume somebody is, inclined mathematically. They can do a quantitative method. Fine. If they're mathematicians, they can start with that because that's their basic. If you're just a guy off the street, right, and you're approaching this market, you don't have quantitative skills, and majority don't, and you don't have a degree in physics, start with the traditional technical analysis that is provided. Support, resistance, RSI, MACD, all those traditional tools.
Are you familiar with, or do you use concepts of R, which would be like risk to reward? If you're, let's say, if you're just taking one contract and on the NQ you're risking 10 points to make 30 points or 10 points to make 20 points. This idea of the percentages of each of your trades being such that over a long term you're kind of protecting yourself just in how you're not even how you're sizing, but how you're the amount that you're risking on every trade being equal, and the percentage that you're seeking to gain versus what you're losing is what's protecting you across a multitude of trades.
It's a really good question. It's a little bit hard to answer, but I will do my best.
Yeah.
So remember I spoke before about, stop losses, right?
Mm-hmm.
Stop losses, like I said, legally they're never guaranteed to be there. But just for the sake of the example, let's say that all the stop losses trigger the price that you wanted, right?
Right.
Think of it, this is the only thing you can control. The only thing you can control is where where you exit when it doesn't go your way. The
Yeah.
reward is the hard part of it, right? And sometimes rigid calculations of risk to reward could be at times a little bit hard. It's sometimes hard on every trade to say, I want always a risk reward of 1 to 5. Well, great. I want 1 to 10. Like, okay, find those setups. Then find the setups that are 1 to 5. Okay, find them. Find the setups that are 1 to 3. So those concepts of, like for example, cut your losses short, let your profits run, they're amazing for amateur traders to listen. Implementing them in real life, it's a completely different story, right? So I don't want to avoid your question. I want to answer it. And I wanted to tell you that, I think for me, the most important thing is really the odds of the setup. The odds of the setup that you became familiar with, right? Now, this setup could be good for 3 months or 3 years, but it's really the odds of the setup that are extremely important. And then over time, you can actually see the risks and the rewards of every single trade and decide, which one you want to work with. That's really what's most important, right? So that's I would say, one way to look at it. But if somebody wants to decide on a risk to reward of, let's say, 1 to 3 for themselves, I can't say that they're wrong. I would always say, look at the odds of your setups. That's,
Right.
to me, is more important than the actual risk to reward.
And what's so tricky about that is that generally speaking, your odds go up on risk to reward trades that are lower reward. So the higher the the higher the ratio, a 5 to 1, a 6 to 1, your odds are much lower than a 1.5 to 1, a 1 3/4 to 1, a 1 1/4 to 1, right? So that's where you have to find that balance.
I think, it, you know, there are markets that are extremely volatile, right? And when they're extremely volatile, then one of the things that happens is that, your risk to reward under those circumstances could be much higher, right? Now, if the market is narrow, that's where, you can't say I want the same reward in that market,
Right.
right? So you have a setup for a volatile market, you have a setup for a less volatile market, or if you don't have a setup for a less volatile market, don't trade. Or if your trades are as such that they're not applicable to very volatile markets, they don't trade, which is also a trading decision. When you don't trade, that's also not that's also a trading decision. I'm not
Sure.
trading this market, right? Some people think that every market, every day, every minute, like, provides an opportunity. Only on hindsight, not in real life, on hindsight, right? So
Yeah, right on. Well, let me ask you this. We've talked a bit about futures. Let's talk about Optimus. Um, there's been a ton of advancement in the world of trading over the past couple of years. We here at TrendSpider are trying to be on the cutting edge of that advancement. Where do you see the futures market heading in the next few years with the technological advancements that are happening right now? How do you see I don't know. Do you envision the futures markets changing over time? Do you envision more participants? Just kind of where is your head at as to where it's headed?
I personally think that, in the last few years, I see more and more retail drawn to futures. I've seen more and more, especially with the advancement of the micro contracts. So I believe that people are drawn to it. It's interesting that in Europe, they have markets such as the spot FX and CFDs. CFDs are not allowed in the US, but I think even those people are looking at futures more because they want to trade through an exchange. So I believe that the volume of futures, in the retail space will increase. Now,
Interesting.
as far as the traders themselves, I think a lot will be drawn to platforms. Like, this is one of the reasons that I love working with you guys and offering TrendSpider, is because I believe that people today are really speaking very openly about the difficulty of trading, especially after what happened with those meme stocks, right? Like, people have really started talking about the difficulty of trading and everything else, and they will look for tools, hopefully in the right places, because everybody wants to sell you a mousetrap nowadays, and the shovel to dig for the gold. But I believe that people like yourself and TrendSpider, the more and more people will be drawn to tools that can give them better decision making. I believe that the software world is the ones that will, where majority, not, I shouldn't say majority, I can't predict, but I would say a lot of traders that recognize the difficulty of trading will be drawn to. So I believe that the retail will get more into futures. There'll be more use of software. And I consider your software also an automated software, because it doesn't can it can trade for you. It can also send an alert. So you can have two things. You can say, I know I'm deviating a little bit, but just for a second, you can say, okay, when this condition occurs, I want to trade and I want to place a trade, which is possible, right? We
Sure.
connected to it, it happens. But there's also a possibility of you saying, you know what, when this happens, this is my precondition and I want to watch. If this happens, then I'll make a decision, right? But I think, I think it will happen, and it should happen, that people will rely on software more than their intuition, because they will realize there's no such thing in markets and in trading such as intuition. You're just as good as your last trade. Of course, people who traded for a long time can speak more intelligently about their intuitive feelings, but nevertheless, whether you're Charlie Munger or whether the best day trader in the world, you need a very specific set of rules for everything. Don't trade without rules. You go into this market without rules, you know what? You'll be done. And think of it as a competition, right? You're competing against very intelligent people. There's institutions who trade, there's HFTs who trade, then there's very sophisticated traders who trade, right? And like, you want to be in their league, right? You want to be in the league of people who think, not in the people who just get up in the morning, see a market that is high. Oh, I think it's overbought. Why? Why do you think it's overbought? Or when the market bottoms, I love those people. Like, I think this is the bottom. How? Like, how do you know? How do you know there's not going to be another flood of sellers? And so the minute people start realizing and reading more about market mechanics, and it sometimes works like an auction, right? So think about it this way. Let's say there's a 68 Mustang in an auction, right? And you have all those bidders, and it starts at 50,000, right? And one guy, he's thinking, should I raise my hand? Should I not? Should I buy it? All of a sudden, 55, 60, 65, right? And all of a
Hmm.
sudden, the guy who was hesitating at 50 is afraid to lose out. So now he's at 70. And, so the markets, you don't know where it's going to stop, right? You're not going to, would you short an auction on a 68 when the market is going up, trying to say this is the last bidder with the highest price, right? So now you're thinking of the market as the auction, right? And vice versa on the short side.
Yeah.
So I think, just to answer your question again, I think that, will be more retail traders that will come in. There's more interest there. And I believe that the future lies in software. The better the software, the more you'll be able to grab thinking software. And luckily, you and Dan and everybody else that I met on your team are good thinking people, And the last thing I want to mention about your software that I like is the interface design. A lot of people, you can design a lot of machines, but you got to make it easy for the customer to navigate through it, right? So I think there's a good emphasis on the UX design, which is also important. So kudos to you. You did a good job.
Thanks. Appreciate the kind words. I'm kind of curious, how does this potential influx of retail into futures affect or does it? Does the influx of retail into futures affect how the markets act on a day-to-day basis? Do they become more difficult because you have an influx of retail traders participating in them? Do they become easier? Do they change at all? What are your expectations there?
It's a really good question. I would start by saying I don't know,
Yeah,
but
yeah.
I don't know. But if I had to get, but I can tell you some observations in general. The beauty of liquid markets is that you can get in and out, right? With less slippage than an illiquid market, right?
Right.
So people want in the future, people are drawn to the futures market because it's a day trading market, right? But you also have to remember that it's a macro market, and the more liquid it is, the more interest there are in the market, and that's what makes the market, what makes the liquid market is also good. It's also what makes them challenging.
Right.
So I believe that the more people that will come in, right, into the space, and there could be even more institutional flow into the space, right? Because people hedge. Don't forget that people use the futures market as a hedging tool. Some people have physical crude oil, some people have physical gold, some people have huge portfolios that they have to hedge, and every day they're making transactions, right? And some people, this is why some people say, I don't understand. I had the perfect setup and it didn't work out. Well, I'm sorry that some mutual fund all of a sudden had to dump, in that moment in time, 10,000 contracts, and, it ran you over. So again, I think, in my opinion, the answer to your question, although I'm not 100% sure, I think that the more people are in any market and the more liquid it becomes and the bigger participation, it definitely would make it more challenging, in my opinion.
Yeah, I kind of have that guess. I assume that as well. Um, so let's close this thing out. Let's talk about Optimus. You guys have been a great partner with us. Why is, in your opinion, why is Optimus the best solution for people who are trading futures?
Well, I'll tell you what we try and do at Optimus as a philosophy, okay? I really, my goal for me and my staff and anybody who's employed, whether it's brokers or whether it's support staff or technical staff or anything of that sort, I want them to be extremely competent, right? Look, needless to say, you have to be nice. So when people say, they have good customer service, I'd like them to say that we're nice. But above all, I want them to appreciate that we're knowledgeable and we're helping them and we're competent. And there's so much to know about this market. Like, I'll give you an example. There's probably 20 gateways to execute into the exchange. There are a multitude of platforms. There are number of exchanges worldwide that you can, that people want to trade to. So the key is always to stay extremely knowledgeable of your industry. And this is what we do at Optimus Futures. I believe that's what led to its growth. If people actually Google, Optimus Futures reviews or anything like that, there's a bunch of places that rank us. I think majority of people are very happy because things are working. They're connecting. You take a platform, you connect it, and it trades. And I know for a trader, they take it for granted. Of course, it should work. But I can't tell you how many people we receive sometimes, and they say, you know what, I can't be connected, or this thing doesn't work, or they don't know the platform, their own platform and their own functionality, or anything like that, right? So we try to simplify things above all, and also stay extremely knowledgeable. Now, every broker in the world thinks that they're the best, right?
Sure.
you know, I claim I can't judge if we're the best or not. I can only, talk about our customer acquisition over the years that has been growing exponentially. We've been growing and more customers come to us, and the more customers come in, the reason that I love it is because it means we're doing things right. And the other thing is now when you deal with larger groups of people, you get feedback, right? So think about something like everybody's using Transpider, right? Now, if you have two guys using it and they're like, I want this feature, I want this feature, I want this feature, it's like, should I do it, should I not? But when you have thousands of users and they say, we want this feature, now you're like, okay, there's something missing in my software. So, or in my services. So the beauty of growth, and this is what I tell people, is that, it gives us better feedback on what people need. It's better data gathering. You can gather data from larger numbers to see what they need. And I would tell you this, my philosophy has always been, since I've been since I've built Optimus, was that every single dollar we earn, it's from other people taking risks, right? And I think a lot of people forgetting this, that somebody needs to get up in the morning, develop an opinion, and they take a risk, and the broker gets compensated through commissions, right? And the markets are difficult and they're hard. They're not, it's not a money tree you come and pick up, your dollar bills from. So I think if brokers keep that in mind, that that's other people taking risks, they will make things a little bit easier for them, right? It's a hectic market. You deal with people's money. Sometimes people get a little bit, I would say, nervous, upset, when things happen. Sometimes it's the market, but it's understandable. At the end of the day, it's the market, right? But we try to remember this philosophy. So when we resolve, connectivity issues, could be like a customer might call and say your platform is not working. Well, the platform is working. But let's look at your internet, right? You have to come down, not to be ego driven, say, okay, let's see how can we solve this problem. The key is always, and you know what? At the end of the day, I will tell you, people do appreciate it. People do appreciate good service. People do appreciate support. And that's it. So, we try to be fair in pricing. We try to be, also provide people the risk leverage and the day trading margins that they want. We always tell people we don't encourage you to over leverage. We do not. But there's a demand out there in the real retail industry to max out capital sometimes. And that's already up to the individual user. I tell them all the time, again, as I mentioned during this recording, choose a size that you can trade with. Don't try to max it out. See where you're at, play around with it for a long time, 3 months, 6 months. And if it's good, do things incrementally. One thing I would tell traders in their growth, grow from, if you're at the stage of 5, don't go to 8, go to 5.5, go to 6, go to 6.5, go 7, right? Because you know what happens when you go slowly with things, as you learn to trade real live money, is that you'll make a lot of insights that are good for you, as opposed to doing things in a fast things where you skip a lot of things, right? So, for example, your day is not finished when you finish day trading. That's where you take the numbers to the journal. That's where you learn what you did throughout the day. You see where you were emotional. You know what? You might find out that at 9 in the morning, after when you start trading until 10, you're the worst trader, and your best trades are from 1 to 3. So trade 1 to 3.
Yeah.
Listen, you don't owe any broker any trades. Trade 1 to 3. It's fine. We'll gain because we have a long-term customer. You'll gain because you have a chance to be a better trader, right? And not to have a short career in futures. Look, a lot of people have short careers in futures, many, and many will do because they don't take those steps, right? So kind of slow down, go at it one step at a time, and hopefully you'll come on the other hand a better trader.
Yeah. So last piece, where can people find you? What's your website? How can they get a hold of you? All that stuff.
Well, I don't talk to customers directly. If somebody honestly wants to talk to me, I'm very busy, but they can find us on the website on optimusfutures.com. There's a site over there, right? And we put everything out there in the open about, all policies, margin pricing, everything there. And there's a contact us at the bottom of the page at Optimus Futures. We try to answer those questions. People can also set up appointments with the technical side and everything else. And that's basically where we're at. And I encourage people also to look at our YouTube. We have Optimus Futures YouTube. You can find us. There's a lot of educational videos there. We actually did a whole series for TrendSpider as well, how to use it. But we also have a lot of educational videos there. Also, to look at our blog, we have a blog. In the blog, we put a lot of educational material. So subscribe to our email because we really put a lot of effort, in educating people. How to use certain platforms, which are popular, and also in general, how to day trade and things of that nature. And also, the last thing that I will mention as a promo, and I appreciate you doing it for me, it's community.optimusfutures.com. So if you have technical questions about futures, and nowadays people prefer not to talk to anyone. So if you do have technical questions and you feel like, okay, I just want to ask it on a forum, we try to give very lengthy and elaborate answers if it deems that those kind of answers. So it's community.optimusfutures.com, and our regular site is optimusfutures.com. That's where they can find us. Phone number in North America is 1-800-771-6748. And in the world, it's 561-367-8686.
Awesome, Matt. Well, it has been a pleasure getting to chat with you today about futures. I hope that we get to do this again sometime.
I sure hope so. You're awesome. You're really good at what you do. It was a pleasure, conversing with you. So thank you for the opportunity.
Cheers, Matt. Well, you take care of yourself and we'll talk again soon.
Okay, talk to you. Take care. Bye-bye.